For nearly 100 years, there's been one month that has terrified investors more than any other. I'm talking about September, the only month in the entire calendar year that has averaged negative returns since 1926. While every other month has delivered gains over the long term, September has been a consistent wealth destroyer, averaging minus 1.16% returns. But here's where this story gets absolutely fascinating. September 2024 completely shattered this pattern with a stunning 2.02% gain, the best September performance in over a decade. This raises the ultimate question that could determine your investment success. Is the September curse finally broken, or was 2024 just a dangerous fluke that's setting up investors for an even bigger fall in 2025? Let me show you just how real this September effect actually is. We're not talking about some made-up pattern or cherry-picked data. This is nearly a century of verified market performance that reveals one undeniable truth. September is different. Since 1926, the S&P 500 has averaged negative 1.16% returns during September, making it the single worst performing month of the year. Every other month from January through December has delivered positive average returns over this time frame. But September stands alone as a consistent destroyer of wealth. And this isn't just an American phenomenon. Researchers from INSEAD, Erasmus University, and the National University of Singapore conducted a massive study examining 47 countries worldwide. What they discovered was staggering. Stock returns were on average 1% lower in the months following major school holidays. In Northern Hemisphere markets, 28 out of 37 countries demonstrated negative September returns. This level of global consistency doesn't happen by accident. We're looking at a genuine market anomaly that has persisted across different economic cycles, different political environments, and different market structures for nearly 100 years. But then September 2024 happened, and everything we thought we knew got turned upside down. The S&P 500 gained 2.02% for the month, marking the index's best September in over a decade, and bringing year-to-date returns to 20.81%. The month started terribly, with markets declining 4.25% in just the first week, before staging a remarkable recovery through month-end. This exceptional performance raises a critical question for every investor. Was this the beginning of a new era, or just a temporary break in a pattern that's been dominating markets since the Great Depression? Cracking the code. The school holiday theory. Here's where this story gets really interesting, because researchers finally cracked the code behind the September effect. And the answer isn't what most people think. It's not about corporate earnings being worse in September. In fact, over 50% of earnings news remains positive during this period, exactly the same as any other time of year. It's not about economic data releases or seasonal business cycles. The real culprit is something far more human and behavioral: vacation schedules. The breakthrough research identified what they called the after-school holiday effect. During major school holiday periods, particularly the summer break that ends in September, institutional investor activity drops dramatically. We're talking about institutional buying, selling, and short selling around earnings announcements declining by 8%, 14%, and 18% respectively compared to other times of the year. Now, you might be thinking, so what? Here's why this matters. Institutional investors are the smart money in the market. They're more sophisticated at processing information. They have better research capabilities, and they're crucial for proper price discovery. When these institutional players reduce their market activity during holiday periods, something fascinating happens to market efficiency. Markets become less effective at processing information, particularly negative information that requires sophisticated analysis and quick response capabilities. Think about it. If bad news comes out during a period when the smart money is on vacation, that negative information doesn't get properly reflected in stock prices immediately. Instead, it gets processed slowly and shows up as weakness when institutional investors return from their holidays in September. The researchers found smoking gun evidence for this theory by examining U.S. states with different school calendars. In states where schools return in August rather than September, like Indiana, Nevada, Oklahoma, Tennessee, and Hawaii, companies headquartered in those states experienced their weakness in August instead of September, with returns dropping by 28 basis points during the earlier month. This timing correlation provides compelling proof that the September effect isn't driven by fundamental economic factors. but by the behavioral patterns of market participants. So where does that leave us as we head into September 2025? The current market environment presents a fascinating test case for whether the September effect will reassert itself or whether we're seeing a genuine shift in market patterns. The S&P 500 currently sits at 6,460 points near all-time highs, representing continued strength following a robust year-to-date performance. The index has achieved its fourth consecutive winning month through August 2025, with 5 new closing highs recorded during the month alone. But here's the game changer that could completely override historical September weakness: Federal Reserve policy. Jerome Powell opened the door to September rate cuts during his Jackson Hole speech in August 2025, with the federal funds rate currently sitting at 4.33%. This represents a potentially massive departure from the tightening cycle that characterized 2022 through 2024. Historical analysis shows that rate-cutting cycles typically provide significant tailwinds for equity markets, particularly benefiting interest-sensitive sectors and growth stocks. The question becomes whether Fed policy support can overcome the behavioral patterns that have dominated September performance for nearly a century. September 2024 provides some evidence that it can. The Fed implemented a 50 basis point rate cut during that month, while second quarter 2024 earnings officially set records with 11.3% growth. These positive fundamental developments overcame traditional seasonal headwinds and delivered exceptional performance. However, current market valuations present a complicating factor. Market concentration remains extreme, with significant performance driven by megacap technology stocks. This creates both opportunity and risk as we enter the historically challenging September period. The elevated valuations mean that any disappointment in Fed policy or economic data could trigger more severe reactions than in previous years. Now that you understand the mechanics behind the September effect, let's talk about what the academic research tells us about how to actually profit from this knowledge. The key insight here is that successful investing during volatile periods isn't about predicting exactly what will happen. It's about positioning yourself to benefit regardless of which scenario plays out. Dollar cost averaging represents the most academically supported strategy for managing market volatility. Research published in the Journal of Financial Planning found that DCA can be used to lower risk and, depending on an investor's risk aversion level, can represent an optimal investment strategy. The strategy works through a simple mathematical principle. You automatically purchase more shares when prices decline and fewer shares when prices rise. This means that September weakness, if it occurs, actually becomes beneficial for long-term wealth building rather than destructive. For more aggressive investors, buy-the-dip strategies have shown remarkable effectiveness under specific conditions. S&P Global's quantitative research analyzing Russell 1000 stocks from 2002 to 2017 found that securities falling more than 10% relative to the broader market in a single day significantly outperformed the index in subsequent periods. The study documented cumulative excess returns ranging from 0.47% over one day to an impressive 28% over 240 days. But here's the crucial caveat that most investors miss. Buy-the-dip effectiveness depends heavily on market conditions and implementation. The strategy performed best during secular bull markets, but proved problematic during extended downtrends. European research published in 2023 found that BTD strategies targeting larger dips, such as 20% bear market declines, yielded better risk-adjusted performance than higher-frequency approaches based on smaller declines. 3 key factors improve buy-the-dip strategy performance according to the research: institutional ownership levels, stock price trends, and company fundamental valuation metrics. Securities with higher institutional ownership established upward price trends, and reasonable valuations showed better recovery patterns following significant declines. This means you can't just buy any dip blindly. You need systematic criteria for identifying quality opportunities, sector-specific intelligence, and positioning. The research reveals consistent patterns in how different market sectors perform during September weakness. Consumer staples, utilities, healthcare, and communication services typically demonstrate relative strength during seasonal market stress, reflecting investor risk aversion during uncertain periods. These defensive sectors don't necessarily go up during September sell-offs, but they tend to fall less than the broader market, providing relative outperformance. Cyclical sectors, on the other hand, often underperform significantly during September weakness. This includes technology, industrials, and consumer discretionary stocks. While this creates near-term pain for holders of these sectors, it also creates the biggest opportunities for patient investors with cash available to deploy. The academic research on buy-the-dip strategies shows that cyclical stocks often provide the largest excess returns following significant declines, precisely because they fall the hardest initially. Gold continues demonstrating portfolio diversification benefits during market volatility periods, and current forecasts project gold prices reaching $3,600 to $3,700 per ounce, supported by record central bank demand and ongoing uncertainty. Expected U.S. interest rate cuts further enhance gold's appeal as a non-yielding asset, since lower rates reduce the opportunity cost of holding precious metals. Alternative investment strategies incorporating environmental, social, and governance criteria have gained institutional acceptance and can provide additional diversification benefits. Academic research suggests that ESG-focused portfolios can achieve competitive returns while contributing to positive societal impact, offering diversification benefits while aligning with evolving investor preferences. The three-tier strategic approach. Based on all this academic research and historical evidence, here's the systematic approach that gives you the highest probability of success regardless of whether September 2025 follows historical patterns or breaks them like 2024 did. Tier 1 is defensive positioning. This means maintaining appropriate cash reserves. Financial planning research recommends 3 to 6 months of expenses in cash for working individuals and 1 to 2 years for retires. This approach prevents forced selling during market declines while providing capital for opportunistic purchases. Treasury securities continue serving as the highest probability defensive strategy during market stress, with their government backing and tendency to appreciate during market volatility making them effective portfolio stabilizers. Tier 2 is systematic accumulation through dollar-cost averaging. Rather than trying to time the perfect entry point, you systematically invest fixed amounts regardless of market conditions. This mathematical approach means that September weakness, if it occurs, actually accelerates your wealth building by allowing you to acquire more shares at lower prices. The key is maintaining discipline and continuing your systematic investments even when market headlines are screaming panic. Tier 3 is selective opportunity identification for investors with additional capital available. This means having predetermined criteria for what constitutes an attractive buying opportunity and the discipline to act when those criteria are met. Based on the academic research, focus on high-quality companies with strong institutional ownership, established upward price trends, and reasonable valuations that fall significantly below fair value due to temporary market dislocations. The behavioral edge. Here's what separates successful investors from everyone else during periods like September: behavioral discipline. Academic research consistently identifies common biases that impact investment decisions during volatile periods. Overconfidence leads investors to make poorly timed trades. Herd behavior causes people to sell at exactly the wrong time when everyone else is panicking. Loss aversion makes investors hold losing positions too long while selling winners too quickly. The September effect, whether it manifests in 2025 or not, will create emotional responses in market participants. Most investors will react emotionally, either with fear if markets decline or with overconfidence if they continue rising. Your edge comes from having a predetermined plan based on academic research rather than emotional reactions to daily market movements. Remember that market recovery from temporary setbacks is the historical norm, not the exception. Research from Cambridge Associates emphasizes that well-constructed asset allocation policies designed to withstand market cycles represent the foundation of successful downside navigation. Success comes from systematic approaches implemented before volatility strikes, not reactive responses during market stress. The September effect represents one of the most thoroughly documented and persistent market anomalies in financial history, validated by nearly a century of data and rigorous academic research from top universities worldwide. While September has historically produced the worst average monthly returns at minus 1.16% since 1926, the key insight for investors is focusing on evidence-based strategies rather than attempting to time seasonal patterns. September 2024's exceptional 2.02% performance demonstrates that fundamental economic conditions and policy responses can override seasonal patterns when circumstances align favorably. Current market conditions entering September 2025, with elevated valuations but supportive monetary policy expectations from the Federal Reserve, suggest that traditional September challenges may be moderated by accommodative policy. The most effective approach combines systematic strategies like dollar-cost averaging with strategic diversification and selective opportunity identification during significant market declines. Academic research consistently supports these evidence-based approaches over attempts to time markets based on seasonal effects alone. Whether September 2025 follows the historical pattern of weakness or breaks the trend like 2024, you now have the knowledge and systematic approach to turn this seasonal phenomenon into a wealth-building opportunity. The September effect isn't something to fear, it's something to prepare for and potentially profit from. Will you let a 100-year market pattern catch you off guard, or will you be ready with a systematic, research-backed approach? Drop a comment below and let me know your September strategy. Are you positioning defensively, planning to buy any dips, or taking a completely different approach? And if this analysis helped clarify your thinking about seasonal market patterns, hit that subscribe button and ring the notification bell so you don't miss our October market update where we'll analyze exactly how these strategies performed. The smart money is prepared money. Make sure you're ready for whatever September brings.